The question of what to do with your stimulus is a really important question to address. It really depends on what your financial goals are. Some people want to get out of debt, others want to improve their credit score because they have a rental situation or a purchase that they'd like to make. Other people just want to increase their savings for an emergency fund or something like that. Those are really important goals. None of those is more important or better than another. It just depends on where your financial situation is currently. So I encourage everyone to do what's best for you. I also encourage you to get the information you need to make the best choice. In this video, I want to talk about that choice that is to improve your credit score, because I think some people have it a little bit confused when it comes to improving that credit score. Maybe I'll come back with other videos and address the other ones. I want to quickly get into why it makes some people confused when they get that lump sum of money. The biggest thing, and I was taught this way growing up, you don't want to be in debt to anyone. So most often we're thinking about our credit as getting out of debt or paying our debt on time. Paying debt on time, that is important. That's 35% of your credit score. But getting out of debt, i.e. paying off creditors or old debt, that's only 15% of your score. The 30%, the next 30% after your payment history is your balance to limits. And so if you're thinking about your strategy for improving your credit score, the best thing to do, number one, is to get your balance to limits below 30%. 30% or lower utilization on your credit cards. That's usually where we look at those numbers. For your installment accounts like your car loan, that doesn't matter. Your mortgage account, that doesn't matter. It's your credit cards, those revolving accounts. You want that utilization down below 30%. So take this money, look at your limits on those credit cards, calculate what 30% is, and get below that 30% threshold. After you've gotten that together, you may want to look at saving to ensure you have a month, at least a month, of credit card payments banked so you can save that. That's not financial empowerment, that's just peace of mind to know that you're going to be able to pay those bills and keep that stuff current so that this crisis doesn't decimate your credit score. After you've got that, I would recommend seeking higher credit limits from your credit providers. So this is advisable if you haven't had hard inquiries on your account, if you've had less than 3 hard inquiries on your account this year. I'd say go to a couple of your credit cards and see if you can get higher limits. Of course, that increases that credit threshold so that you can have those balance to limit numbers below 30%. It's another way to do it other than paying them down. And then once you've got that taken care of, you can take care of that 15% of your credit score, which is paying off bad debt. A couple of ideas there just quickly. If you can get those below 30% and get them to be paid on time, so make them current and on time, that actually is better than paying them off. If that's not an option, if they're less than 2 years old, and those are the ones you should be concerned about, then look at negotiating. Make sure you call the company, get them to give you a lower payoff amount. You also want to get that payoff amount in writing before you pay anything over the phone. And for your last thing is to make sure that you have an overall strategy for your income as the months go forward. So if you are fortunate enough to still have income coming in, you want to make sure that you're applying these methods over time, just like you are when you're faced with a lump sum of money. That's it. Talk to you soon. Oh, and I should mention, I have a training that is available for just such a topic, my financial levels to literacy. So be sure to check that out. Peace.